Hi, Cherif Medawar here, and I have the opportunity tonight here in New York
to speak with attorney William Blum.
and I want to let him introduce himself and tell us a little bit about international tax law for these great tax incentives that we can have as U.S. citizens, investors, and business owners. Bill, so nice to have you. Thank you for coming.
Thank you for inviting me, Cherif. Yes, I'm a partner with the law firm called Solomon Blum Heyman in New York City. We've been in existence for about 20 years. We also have an office in the U.S. Virgin Islands. My specialty is in international tax and a subspecialty in taxation of U.S. possessions, commonwealths, and territories.
Fantastic. Great background. I read so much about you. So glad to finally meet you in person. So let's talk a little bit about Puerto Rico tax incentives. I understand there is the Act 20 and Act 22. You want to give just a quick overview about these?
Sure. Traditionally, over the course of time, Puerto Rico has had a number of tax incentive laws. A lot of them were designed to encourage manufacturing in the islands. And in 2012, they decided to pass a new set of laws, Act 20 and Act 22. Act 20 is designed to attract mostly service industries to Puerto Rico. It's changed a little bit in terms of its requirements, but mainly it requires an owner to set up the corporation, to hire 5 Puerto Rico residents as employees. That can include the entrepreneur who sets it up as long as he's living in Puerto Rico. And it has to be approved by the government in terms of what types of activities it's undertaking. And ultimately, once it gets its approval, it pays tax to Puerto Rico at the rate of 4%, which is obviously a very nice rate as compared to U.S. tax rates.
Yeah, it's very good, very good.
So also in 2012, Puerto Rico passed Act 22. Act 22 is designed for a somewhat different purpose than Act 20. It's designed to attract individuals to Puerto Rico who have not lived there for the last 15 years. If you meet that requirement and you relocate to Puerto Rico, you are eligible to pay a zero tax rate on certain types of income, dividends or interest that come from Puerto Rico sources, which means in the case of dividends from Puerto Rico corporations, in the case of interest from banks in Puerto Rico or borrowers in Puerto Rico. But also importantly, capital gains of certain types, mainly on the purchase and sale of stocks, although not real estate necessarily. If you purchase stocks and you sell them when you're in Puerto Rico and you have a gain that was earned while you were a resident of Puerto Rico, that will also be subject to zero tax in Puerto Rico, a really good benefit. It's really very unique. Nowhere else under the U.S. flag can you get that benefit.
Yeah, it's very good, no doubt. So let's talk about, let's say, an entrepreneur of some sort that lives in California, would like to take advantage of not moving physically to Puerto Rico to live, but to actually just take advantage of Act 20. What kind of structure or structures could he
Right, so he wouldn't be eligible to Act 22 because you have to move there for that, but under Act 20, he can establish a Puerto Rico corporation. There's 2 ways to do it: a regular, what we call a C corporation, or an LLC that checks the box, which means it's taxed as if it were a corporation. That corporation would be the certificate holder, the entity that applies for the benefits, gets a decree from the Puerto Rico authorities. So the corporation itself would pay that 4% tax that I mentioned earlier. Notwithstanding that he's not living there, as long as he still has the 5 employees and the income is from Puerto Rico sources, which is important under both of these acts, because those are the only ones that the federal government will let you pay a reduced rate on. Then you can still get the 4% rate. And then the question is, well, what happens to the income that he has built up within this corporation? How does he get it out? Well, he has a couple choices. One, if he decides later that he wants to move there, dividends from a Puerto Rico C Corp that is an Act 20 corporation to a Puerto Rican resident, whether you have Act 22 benefits or not, are subject to zero tax in Puerto Rico. So that's one option. The other option, no, it doesn't want to move there at all. then he can have the dividends paid to him back in California. He'll pay the qualified dividend rate, which is presently, I guess, 23.8%, plus whatever California charges, which is probably quite a bit more. But it's still a better deal than if he had some type of foreign investment or a regular wage that was taxed at 39% plus local tax.
Got it. And could it be a second option that he or she would accumulate the money there and just let it grow and then maybe relocate to Puerto Rico for a short period of time?
Right. Well, it would be at least a year. We recommend our clients do at least 2 years, even though it's not technically required. You don't want the IRS to come along and basically say, well, you didn't really move there. Yes, you can accumulate it there, move down, take your dividend out, and then maybe move back in a couple of years and still get that zero tax rate.
Good. And you had mentioned to me earlier, we were talking, and you said it's Internal Revenue Code 937. That's the one.
Well, 937 controls, discusses two subjects. One is the residency rules, which we can talk about a little if you'd like, and the other is the source of income rules. Both of those are important. But that's sort of an additional section, 933 of the Internal Revenue Code it's very short, but it basically says if it's Puerto Rico source, Puerto Rico is authorized to reduce that tax, and that, you don't have to pay the regular rate.
So the IRS is okay with it based on that code?
Hey, it's Internal Revenue Code. They're stuck with it. Congress passed it. So they may not like it, but it's there. Taxpayers tend to like it. So 937 residency rules you have to refer to those if you are moving down there and you want the Act 22 benefits or any of the other benefits that apply only to residents. There's 3 parts to the residency test. It's called bona fide residency in a territory. And these same rules apply to all the territories, Puerto Rico, Virgin Islands, Guam, all of the territories. The first part of the test is basically a day counting test, and there's several versions of it, but the main one that most people qualify under is that you physically spend 183 days per calendar year in Puerto Rico or the other territory it might be applicable to. The second part of the test is called the tax home test. To meet the tax home test, for the entire tax year, your main place of business has to be in Puerto Rico. That's pretty easy to meet. If you're living there, that's going to probably be where your main place of business is. Good point. And then the third one is what they call a closer connection test. And it's a qualitative test. You look at a number of different factors. Where does the person have a home? Where does their family live? Where do they do their banking? Where do they do their business? Where are they members of clubs? And you compare all of those factors in Puerto Rico with all those factors anywhere else that they might live or have a house or have a membership or whatever. And as long as you can conclude that they have a closer connection to Puerto Rico than anywhere else, you meet those tests. If you meet those 3 tests, you're a bona fide resident of Puerto Rico.
Excellent. So what if somebody is doing business with a group of partners, let's say in Ohio or in Wisconsin, and they would like to take advantage of Act 20? Is there a structure they could work on together?
Well, there's a couple different possibilities there. One is if they each have their own business and they want to join together in some type of a partnership, they could form an Act 20 company together that has more than one business. I mean, there's some downsides to that. There's potential liability between the partners that you might not want to have to worry about, but it works for some people. The other possibility is maybe of 5 partners, 1 or 2 want to move down and run the business and get the full tax benefit. There isn't any reason that they couldn't do that and have 3 sort of passive partners or stockholders back in the States, and they would each get their own separate tax treatment. So the guys who lived there would take their dividends out tax-free. The guys who didn't would pay the qualified dividend rate. Or perhaps one of the guys who didn't move down could move down later and take out the dividend later.
So they can let the dividend accumulate tax deferred until they either repatriate the money or go down to Puerto Rico to
take it out when they're there.
Become residents.
Right. I mean, there's some complications with that because usually with a corporation you have to take out your dividends at the same time. But there's there's some flexible ways. If you use an LLC type structure, you can have a lot more flexibility.
Very good. So what kind of cases have you handled that had to do with IRS questioning somebody's tax deferral situation, all this, based on source of income and all that?
Sure. fortunately, so far, because the program is pretty new, there's not been a huge amount of IRS activity with respect to Puerto Rican tax incentives, Act 20 and Act 22. A lot of my experience has been prior to Puerto Rico and still with the U.S. Virgin Islands. They have a similar program. It's got somewhat different requirements, somewhat different laws, but enough similarities that it's comparable. There were some abuses in the early 2000s, and the IRS came down and decided to audit a number of people who were involved in the USVI tax incentive program. Frankly, overall, over the course of the last 15 years or so, the IRS has been rather unsuccessful in taking a lot of additional tax from taxpayers in the Virgin Islands who took advantage of the program. But no one wants to invite an audit. You want to play by the rules. You want to make sure you're fully informed as to what the rules are in advance. You may want to get a tax opinion from a law firm or someone like ourselves who could make sure that you know the ropes and that you're following the exact letter of the law. Most of those IRS audits in the Virgin Islands had to do with residency challenges. But you have to remember that the residency rules I mentioned, the Section 937 rules, were not even in place until the mid-2000s. The Congress charged the IRS with making those regulations back in 1986. And the IRS waited over 20 years to make the regs. We in the profession were saying, tell us what to tell our clients. And finally, we got the regs, and now the regs I explained on residency have sort of really eliminated that aspect. But you mentioned source of income, and probably should address that a little bit.
Let's talk about source of income.
You do have to have Puerto Rico source income to gain the benefits of either Act 20 or Act 22. And source of income is a fairly complicated subject in terms of international taxation, and it may not be quite as obvious to the layperson exactly what the source of their income is. So if you got a check sent to you from someone in Puerto Rico, you might think that's Puerto Rico's source income. Well, it may not be. You have to analyze the income itself. So if a Puerto Rican borrower pays interest to someone, that's Puerto Rico's source income. If a Puerto Rican corporation makes a dividend to someone, that's Puerto Rico's source income. And if you are physically present in Puerto Rico doing services, the payment for those services are Puerto Rico's source income. So those are all good things in terms of Act 20 and Act 22. But if I know you're involved in real estate and you're going to be using this in a real estate seminar. Well, let's say that you have a rental property in San Francisco and it happens to be owned by an Act 20 corporation. Well, the source of rental income is the place where the property is located. So that is going to be U.S. source income and is not going to be eligible for the tax incentives because of Section 933, which requires Puerto Rico source income.
Got it. However, correct me if I'm wrong, if we provide management from Puerto Rico as the source of the service being exported is out of Puerto Rico, we can reduce whatever is going to be invoiced. Am I correct?
Absolutely. So you've pointed out something I neglected to mention earlier, which is Act 20 is designed for export of services. So yes, if you perform services in Puerto Rico, those are going to be Puerto Rico's source. But now the question is, okay, but my real income is rental. How do I move some of it to Puerto Rico? And you hit on the answer, a management fee. Now it has to be a real management fee. That is, you're going to have real management taking place and real people doing things in Puerto Rico that generate service income.
Form and substance.
Yeah, and let's say in most cases you would say, well, I own the property in California, and I own the Act 20 company. So if you own both, there's a whole set of rules in the Internal Revenue Code that says, well, if you own both sides of the transaction, you have to make sure that arm's length price is being paid.
So that's where the price transfer study comes in.
Right. So we recommend to all of our clients, you need a transfer pricing study in order to justify the arm's length price. So You hire an economist, basically, and they say, yes, well, the normal management fee for that type of work on a rental property is 15% or it's 20% or whatever it is. They look at the industry and they see what the right price is and they make a recommendation as to what you should be paying.
Great. So if I am the service provider and I am the one invoicing, not a related party, there is no need for a price transfer study?
Right. So if you set up a real estate management company as your Act 20 company, and you offer real estate management services to people that are not you and not your relatives, they could be your friends, but there's no reason to believe that you would not be charging anything other than an arm's length price, then you don't need the study. But if you're on both sides, then you need the study.
So again, the same rules like being reasonable, something reasonable, necessary, ordinary, and...
Right, no, of course, in terms of expense deductions, you have to have ordinary and necessary expenses.
So source of income, so rental income, the source is where the property is.
Correct.
Stock dividends.
Dividends where the company is incorporated.
Okay, so somebody becomes resident of Puerto Rico.
Right.
And he owns some stocks and they pay dividends.
Right, he owns, so the question is, the stocks are of what company? So if it's a Puerto Rico company, then those are Puerto Rico source. But if he invests in IBM, that's the U.S. company. So that would be U.S. source income.
What if it's capital gains, he buys and sells the stocks? And he
now we're talking of one of the most important benefits under Act 22, where one of the types of income that's subject to Act 22 benefits is capital gains that relate to things like stocks, not real estate, because the source of capital gain income on real estate is where the real estate is located. But the source of income for personal property, which includes stock, is the residence of the person who is buying and selling the stock. So if you move to, you live in Puerto Rico. If Joe Blow moves to Puerto Rico, buys some U.S. stock, he buys IBM for $100 a share, he holds it for 2 years and sells it for $150. That $50 gain is going to be subject to zero tax in Puerto Rico.
Under Act 22.
Under Act 22.
And under Act 20, if the person has the bona fide office, the 5 employees, it will just pay 4% tax.
Correct. On the Puerto Rico source income
of
the corporation.
Of the corporation.
Right.
But if somebody bought and sold a property, let's say flipping a property in California, the tax is going to be due in California.
Right. The IRS is going to charge tax on it. California is also going to charge. So it doesn't work for that.
Yes. Unless, of course, like my Act 20, let's say I'm advising, I mean, we talked about this, I advise companies to find certain deals and I say, you know, if I get you that deal and I help you flip it, then you owe me X percentage.
So that's akin to a brokerage fee or a commission.
A commission.
And if you're earning that commission or fee due to your or your company's personal services that are performed in Puerto Rico. So, you know, you introduce that deal to the person, you know, from Puerto Rico, or you provide some other services out of Puerto Rico that justify the fee, then that could be, that would be subject to being treated as services income and therefore subject to tax.
So at what stage
tax exemption.
Tax exemption, thank you. Thank you for that. So at what stage should an investor or a business owner contact your office if they want your services? At what stage? When they start thinking about it or when they formulate exactly the whole thing? What do you suggest?
Well, certainly once they've gotten comfortable with the Puerto Rico program and the local requirements, that is, if they can meet the 5 employees and if they're going to live there, if they've maybe gone down there once and checked it out and decided, yes, I can handle this, then typically we'll start to talk to folks at that point and say, okay, you're ready to do this, let's structure it correctly. What type of income do you plan to earn down there? Are you going to move there? And then we can advise them as to what the tax consequences will be and how to avoid problems with the IRS. We can also refer them to Puerto Rico Counsel, who will help them get the Act 20 benefits or the Act 22 benefits. But to tell you the truth, Act 22 is pretty simple. You don't necessarily even need counsel to get the benefits, but you probably need counsel to advise you to make sure that you've done it correctly from a U.S. perspective. And frankly, most of the clients that we get are asking us for legal opinions and structural advice so that if and when they get audited, they can say, well, I did it in the manner that counsel who's familiar with this has recommended. Here's my opinion letter. And then even if they made a mistake, and even if they did it wrong at that point, they have the bona fides of being able to say, yeah, but I did it in accordance with this advice. So the likelihood of penalties is very low.
Very good. Excellent, excellent. So at what income level should somebody consider Act 20?
That's a really good question, and it really depends kind of on the economics of the business. But since Puerto Rico has a requirement of 5 employees, and some people come and say, well, okay, I'll hire a driver and a janitor and a couple of maids. And you know, it's like, no, you're not going to get your benefits if that's what you're doing. You'd better hire a manager and a sub-manager and maybe, you know, a couple secretaries and you know, an
qualified team.
Yes, qualified team. So now all of a sudden, you know, you've got some expenses because you have to actually pay those people what they're worth. So I guess we find that unless you're going to gross probably at least $1 million, it's probably not going to be worth the effort of relocating and trying to manage a business perhaps from afar. Puerto Rico is a good place. It's got good workers, but it's not the mainland. Yes. So there are some disadvantages you have to overcome. So
of course, it's an island and has its challenges.
Right.
But I want to mention something you said you would have to consider about relocating. But Act 20, again, they don't have to relocate.
no, they definitely do not have to relocate to get the benefits.
Yes, but
they
they
get
have to have
more
the team.
benefits if they do relocate.
Yeah, but
and they have to run their business. But certainly the company itself, the Act 20 company that you're setting up in Puerto Rico, is the one that's going to get those benefits. And on top of that, you get, if you are a resident, you get the dividend for free.
Yeah, tax-exempt dividend. So wonderful. Any words of wisdom regarding somebody setting up other than kind of figuring out the numbers and seeking legal counsel like your experience and your team? What other things do you think they should do?
Well, just in terms of island life, I mean, I think you mentioned it before. I mean, you have to make sure that you're comfortable with you know, that type of a lifestyle. Now, some people say, how bad could it be? I've got the beach, I've got the ocean, I like to sail. And that's fine. But I strongly recommend that people spend at least a little bit of time in Puerto Rico before they make that decision. Very good. So yeah, there's that, and so lifestyle is part of it.
Excellent. So, so the ideal businesses we have in my company, in the CMREI, the structure of the seminar company, I have a lot of people that do real estate investing, either commercial properties that they buy and hold, or they buy properties, fix them, and resell them. So these people would have to actually apply for an Act 20, get approved, have an office, hire 5 people, and then that structure will allow them to route some eligible services that are being exported from Puerto Rico to reduce their overall taxes.
Right. So part of the structuring that we advise clients on is exactly that. What is it that you're going to be doing in the States, and what is it that you're going to be doing in Puerto Rico? And as you said, they have to provide services from Puerto Rico in order to justify the source of the income in Puerto Rico. So you cannot expect, if that's the business that you just described, that most or majority of your income is going to be subject to these benefits, because you have to deal with the transfer price. You have to figure out, well, okay, you know, if it's a 20% commission or 20% management fee that's being paid, if that's a reasonable number, well, then 20% of that profit probably could be subject to the tax incentives in Puerto Rico.
Very good. Are there any other places in the world that the U.S. citizen can legally reduce taxes like this, other than U.S. Virgin Island and Puerto Rico and Guam, maybe?
You've named the 3 that are the most popular. There's a couple other territories out there, but I don't think that their programs are as popular as the ones you mentioned.
All right. So Puerto Rico, somebody uses Act 20, routes some money legally through Puerto Rico by exporting services, and now that person has some money sitting in a bank account in Puerto Rico, and the income is not being taxed in the U.S., it's being tax deferred, if you will, for the U.S. until they repatriate the money or decide to go and live there. But what if they loan that money to some other entity? The interest income that comes to them, that's, what is that source?
Well, if they're loaning it to another Puerto Rico entity, or even to Puerto Rico business, or to Puerto Rico government through a bond or something, that would be subject to, now that would be Puerto Rico's source. Now whether it's subject to Act 20 benefits depends on the exact wording of their decree. It would be definitely subject to Act 22 benefits if they were to lend that money. So maybe you pay your dividend to yourself out of your Act 20 company and now you buy some Puerto Rico bonds. That's all going to be tax-free.
You want them to buy bonds?
I didn't say they should, but I said if they did, and I tell you, probably Puerto Rico bonds are a pretty good deal right now. But I'm not giving investment advice, believe me, especially regarding Puerto Rico. But there's I'm sure that there are private sector bonds in Puerto Rico that are probably a lot better of a deal than government bonds as well, at least at the moment. So you have the potential there for reinvesting, and the other thing, of course, is you could reinvest in a real estate deal in Puerto Rico, for example. Maybe you want to buy a hotel in Puerto Rico.
Yes, exactly. We can group a bunch of people and have...
You could put a group together and possibly do a Puerto Rico real estate investment. It could possibly be a separate Act 20, or there are other tax incentives in Puerto Rico that are specifically for hotels. So if you're willing to leave the money in Puerto Rico, you have a number of choices.
Yeah, I agree. Actually, I did a hotel in Puerto Rico. I have a hotel on Cristo Street in Old San Juan, and I applied for Law 74, which was a tax credit of some sort. It was really exciting. But let's go back for a second to the Puerto Rico corporation now loans, let's say, somebody in New York or in California.
Right.
And that entity in New York, it's at arm's length. It's some company that they loan them, and they're receiving, let's say, an 8% interest.
Right.
When that money comes, what happens? Do they pay taxes in?
So, well, it's probably not the best structure because the Puerto Rico corporation, from a U.S. tax perspective, is a foreign corporation. And foreign corporations, and the income that you just mentioned is U.S. source because it's being paid by a U.S. borrower.
So it would be...
So now you're going to be taxed by the U.S. On a 30% withholding basis on that interest at the source, and then you're going to receive it in Puerto Rico, and it's not subject to the tax benefits, so you're going to pay tax in Puerto Rico as well. Now you'll get a credit in Puerto Rico for what you paid of the 30%, but so nothing's stopping you, but you're not going to get the tax benefit.
Got it. So they'll be better off really doing business in Puerto Rico with that money.
Yes, absolutely.
A very good point. That's an awesome point to mention because a lot of people had that question.
And just to draw the distinction here with the Virgin Islands, if you had the same situation in the Virgin Islands, you would have the option there not only of investing in the Virgin Islands, but perhaps investing foreign. Because now if it's foreign source, but it's effectively connected to the Virgin Islands, you get that extra benefit. Okay, but so not the States.
Not the States, yes. Yeah. So how about if Puerto Rico loans it to some company in China?
Right.
They will not be...
Now it's Chinese source, and from a Puerto Rico perspective, it's not Puerto Rico source, so you're not going to get the benefit.
So you'll pay taxes as if it was just income.
Yeah.
Okay, got it. Well, very good. I think we covered some great points. Anything I've missed or anything you want to mention that the IRS would be just leery about or concerned about in these structures?
I think in these structures, there's two areas where the IRS is going to pay particular attention. One is residence. If you're claiming residence and you, particularly if you continue to maintain a residence in another jurisdiction, so you have a mansion in Palo Alto, but you have a small apartment in Puerto Rico, even though you meet the 183-day test, they might take a look at that and say, is this person really a bona fide resident of Puerto Rico? We will help advise the client as to how to make sure they don't fall into that trap. The other would have to do with transfer pricing that we talked about before. If you do this structure where you, let's say, charge a 20% management fee, they're going to take a hard look at that management fee. And if it's not an arm's length fee because you're charging it to a company that you own, they're going to want to see a transfer pricing study. They're probably going to, you'd be well advised to have a legal opinion that backed it up as well. So you want to come armed with that in case the IRS looks at your situation. And as little as we like to say it, I mean, it's our job as lawyers to advise clients.
I read an article you even wrote about why Puerto Rico is also legit and these programs are
Absolutely.
true and they're blessed by the IRS. And provided they're structured properly,
Structured
you know,
properly.
you just follow
Well,
the
they're
law.
blessed by Congress. I
Yes.
have to say, IRS does not like these programs.
Yes. Great. Well, any last words of wisdom for the listeners?
These are unique programs in the territories. Puerto Rico is particularly interesting because it's got both Act 20 and Act 22. It's not a bad place to live. I lived in the Virgin Islands myself, visited Puerto Rico many times. This is not for everybody, but for some people it's perfect, and we've had a lot of very happy clients who've
Very
taken
good.
advantage. Yeah.
Very good. And if people want to reach you, can they just go to your website? What's the website?
The website is www.solblum, that's SOLBLUM.com. That's our firm's website. You'll find links in there to my contact information as well as some articles I've written on the subject. And I invite folks who've seen this video to give me a call or send me an email, and be happy to consult.
Great. Bill, thank you so much for your knowledge, your time, and
My
expertise.
pleasure. Thank you, Cherif. I appreciate it.
Well, thank you everyone for listening. And if you have any questions, shoot us some emails and we'll try to answer you, or you can see if you can schedule a consultation and maybe he can take you to the next level regarding these creative structures. Thank you so much.